Thank you for joining us for the Thought and Action podcast. I'm your host, Eric Flegel, and this is where we talk about what's going on in the world of wealth and what you can do about it. Thank you for tuning in. Today, we're joined by Tom Carroll, founder and CEO of Ballast Rock Capital. The thought for the day is how investment in real estate can have a positive social impact and how that fits into a portfolio. The action is deciding how to apply this, whether you're a direct owner of real estate yourself or looking to add real estate to your overall investment portfolio. Real estate investment is a broad subject. So let's start, Tom, with you telling us about Ballast Rock as a company, its area of expertise within the real estate market, and the age of the company and some of your successes.
Absolutely. So Ballast Rock was founded in 2018, and it was built off the experience of a prior real estate private equity firm that I'd run. And Ballast Rock focuses specifically on workforce multifamily housing across the Southeast. So we have a dedicated geographic focus and a dedicated asset class focus, because as you rightly point out, real estate is a very, very broad asset class. So we have a niche focus and a niche specialization. The reason that we focus on workforce multifamily housing is because not only does it have a very unique demand and supply dynamic here in the United States, in so much as we're acquiring assets typically at 1/3 to 1/2 the cost of construction. As a result, we never need to worry about incremental supply. So supply is not a concern. There's highly limited supply of workforce housing. And at the same time, demand is, if anything, increasing for workforce housing. So let's talk about what workforce housing means. It really means people that have a job, that are residents that have a job, that are earning between about $25,000 and $65,000 gross household income. So our residents are typically police officers, teachers, nurses, junior doctors, and people working in the service industry across the board. We focus exclusively in the Southeast and specifically in small to medium-sized cities such as Columbia, South Carolina is a good example, Fayetteville, North Carolina, Macon, Georgia, Albany, Georgia, Valdosta, Georgia, all examples of the types of small to medium-sized cities that we invest in. We actually, though we have two corporate offices, one in Atlanta and one here in Charleston, we do not invest in Charleston nor in Atlanta. We don't invest in Atlanta and Charlotte because those two big hub cities for the Southeast are, there's just too much capital chasing deals in those locations. And we don't generally invest along the coast, though we live there and we love it. We don't invest there because all of the coastal cities such as Savannah, Charleston, Hilton Head, Myrtle Beach, they all have a heavy focus on food and beverage and hospitality, both industries that in any economic downside have significant downside and concentration within that workforce grouping of kind of 25 to 65,000 gross household income. And so you ask about successes. In 2020, our revenues went up by 10% across our portfolio in the Southeast. And I think that's proof positive that our focus away from the coast has paid off. Obviously, we did not see COVID coming. I don't want to pretend to be clairvoyant, but we did know that the next economic down cycle would hit hospitality and food and beverage particularly hard. And we wanted to avoid cities that had employment concentration in those areas, hence our focus away from the coast. And that's a play that's worked out extremely well for us. So revenues went up in 2020. Also worth noting, our collections were unchanged for any month in 2020 versus pre-COVID. So even though this initially there was a CARES Act moratorium on evictions, and then there's been a CDC moratorium on evictions that's still in place. So even though we've been unable to evict in most circumstances, which is an important tool for landlords. Not one that we turn to first, but it is an important tool. Despite that, our collections have remained unchanged versus pre-COVID, and our occupancy has remained, actually is now higher than it was pre-COVID. So I think all of that speaks to the demand here in the Southeast, the amount of growth, of wage growth. The Southeast historically has had lower average wages than the rest of the country, or much of the rest of the country, but the level of wage growth has been very substantial over the last 10 years. And unemployment generally here in the Southeast is run at lower levels than most of the rest of the country. So it's a growth location, as you know, Eric, living here. There are cranes constantly on the horizon, which is always a sign of development and growth. So our focus on the Southeast has paid out. Our focus on workforce housing and the demand supply dynamic has paid out and been very successful. Last year, we paid 9% cash on cash to our investors. That's in 2020. And in 2019, we'd also paid 9% cash on cash to our investors, extremely healthy. And at the same time, that's just on the income side. We believe we've meaningfully created capital appreciation as well. At the moment, we think it's somewhere in the context of 2 to 3x on equity in 2 years in the first fund. So, we've created a huge amount of value for investors, and I think that's really ultimately our success.
Take me through just in general, because obviously fantastic performance. I don't want to just gloss over it. Those are meaningful numbers. But take me through, the advantages that an investor would have investing, with you or a fund per se, versus, just directly investing in the real estate and managing it themselves individually.
It's an excellent question. Ultimately, the advantage of working with us is a fewfold. First and foremost, we are taxed as a partnership, which means that you get all of the same benefits as from a tax perspective of depreciation and shielding of your income from income investing. You get all of those benefits, even though you invest with a professional manager that's doing the work for you on a daily basis. So first, it's worth noting there's no difference from a tax perspective investing directly yourself in your own real estate and investing through us in terms of broad tax structure. However, we use things like cost segregation that a smaller individual investor would probably never use. You would use something called rule of thumb depreciation, which is much slower. We use something called cost segregation, which enables us to create very sizable tax losses, passive tax losses up front, which can be utilized not only to shield the income that we're going to pay you, but also to shield other passive income in your portfolio. So it becomes very, very tax advantageous to work with us. On top of that, investing in a fund means that it is a non-recourse investment. So if you invested for round numbers, 100 grand, all real estate has risk. Anyone that tells you otherwise is not telling you the truth. Though I would argue it's far lower risk than most other risks that you probably already have in your equities portfolio. But you have 100 grand in my example at risk, but you do not have anything more than 100 grand. Whereas when you go and buy your own real estate, you're typically putting a personal guarantee on that debt. And as a result, you are at risk for much more than just the 100 grand of equity that you've used to purchase the property. You're at risk for all of the equity and all of the debt. So again, investing through a non-recourse structure like ours means that you take no risk to that leverage in terms of additional guarantees, whereas investing yourself, you do take that risk. So it's lower risk. The other point is, of course, it's diversified. The Sunbelt Fund 2 is a 50 million equity raise. We'll be using that 50 million of equity to acquire between 120 and 130 million worth of real estate across North Carolina, South Carolina, Georgia, Eastern Alabama, and potentially Northern Florida. It's going to be a diversified fund with likely our average acquisition is around 10 million. So likely you're talking about 12 or 13 different assets in that fund spread across different states, different cities, etc. So you get that diversification that you as an individual investor could never create because you probably just don't have the capital for it as an individual. So same tax advantage, in fact, better tax advantage, no exposure to recourse on the debt, and but the benefits of leverage. And diversification. Plus, critically, and you could argue this is probably the most critical point, it's our deal funnel. Our team underwrote hundreds of deals in our space over the last few years. I personally have been on site for 70 or 80 deals over the last couple of years. And as we acquire, and in so far, we've underwritten, at the moment, more than 200 deals. We've high level analysis on 200 more than that. And we've actually only acquired 10 deals in total. So our deal funnel is exceptionally broad. We have contacts throughout the seller and broker markets of our specialist niche asset class in our specific geography that you as an individual buyer would never, ever have access to. We are getting all of our deals off market before they've ever been blasted out to a larger audience. Therefore, guys like us have already trolled over the deals before you even see them. So we are able to separate the wheat from the chaff and acquire the better deals and get the better portfolios. I mean, it should be no surprise. This is an illiquid market where insiders, it's actually one of the unique markets where insider trading is perfectly legal and perfectly normal. And it is, it is what it is. And that's, and so that access to that deal funnel, I think, is probably our largest single value add. So it's diversification. And then ultimately, you don't need to worry about unplugging some resident's toilet at 2 a.m. in the morning, or even communicating with a property manager that's unplugging their toilet at 2 a.m. in the morning, because we handle all of that. So we have a big team. We have 65 employees on the property management side. All of our property management is done in-house. We do not use third parties. And I would caution anyone that does use third parties. I've got direct experience from it. We've learned the hard way that using third parties does not work, or it certainly does not work as effectively. So, I strongly recommend working, any team that you work with, you want to work with the most professional guys out there. And I would argue at the moment we are the most professional guys in the Southeast doing what we do. Ex-Goldman, my partner's ex-Goldman, you've got a bunch of ex-Wall Street guys that have, brought, I think, a significant level of professionalism to a price point that typically is ma and pa type investors, individual investors. And the core to our strategy is that we are professionalizing the asset class, professionalizing the management, delivering safe, clean, and affordable homes, which speaks to our social impact, safe, clean, and affordable homes to working families. And at the same time, providing for investors high performance, high levels of communication, and access to the management team. We report on a monthly basis. We do financial reporting on a quarterly basis. We do, we have third parties preparing financial reports on an annual basis as well, our accountants. So, a level of reporting that is just untouchable at our size as a manager. And that's just based on my experience coming from a big institutional shop.
Right. I want to ask you a question. We have about a minute left. The social impact, that's the positive social impact that I think a lot of investors obviously find the performance very compelling, but the social impact, I think, is kind of the cherry on top. Can you talk about that a little bit?
Absolutely. So one of the commitments that we make when we step in, we're often buying from ma and pa owners that have, in many cases, run properties very poorly. They've tried to improve performance by reducing expenditure. We find that that's not the best way to do it, that in fact, you create a virtuous cycle by investing in the amenities, the quality of living, the safety of these apartments and of these properties. You're able to create a better community. And that better community, as I said, is a virtuous cycle. You reduce the amount of turnover, you improve your capacity to generate rents over time. But we step in When we acquire these properties, we do not go in and evict everyone and start fresh with ground up redevelopment. It's quite the reverse. We're investing in the properties in the exteriors, and slowly, steadily over time, as there's natural attrition, we renovate units, and those renovated units typically are renting 20 or 30% above where the classic units are. But we are not kicking out existing residents. That's our social compact or social pact, that we are focused on maintaining the existing resident base and slowly and steadily renovating as there's natural attrition. And so 3 to 5 years out, this property will be radically different to what we've acquired. And all the while, we've reduced crime, we've improved security, and we've delivered safe, clean, and affordable homes.